Good morning, everybody. Welcome to the Ankerstar Wealth Morning Show. On the road, as you can see, I'm in what's called escape the whistle mode. If you're a volleyball parent, you know that there's a kabillion whistles. You even leave the gym, you still hear the whistles for like another hour in your own head. So it's kind of crazy. So there's no place inside. So I am outside in Dallas right now. I'm repping UNLV. All the coaches are here to watch Lexi, and the several other commits that are headed to UNLV are all playing in this tournament because they're all from Texas and Oklahoma. So it's kind of cool. And we're 1-0. I know you were worried about it. So let's talk about what we're going to talk about. Let's see. Did anything interesting happen last night in the market? Oh, yeah. Okay. Israel finally, we had the strikes this weekend for Iran into Israel. And their defense minister the next day said, we're going to do something. And then, of course, it's kind of nice when a few days go by. That means maybe, some cooler, more of a calculated response and an emotional response, which is what you'd hope for. But we're at that. I'm going to talk to you about where we are with those strikes. Mike's going to talk to you about the S&P 500. Yesterday we were talking as if this green was going to actually last the whole day. It did not. We were wrong. So it ended up was in red, S&P in the red again today. So he's talking a little bit about that. And then he's going to talk about a company you may or may not know of. But if you're I would say kind of I want the latest, hottest thing. There's this super microcomputer company out there. It's been on a tear. It went from nothing to something, and now it's kind of not doing that anymore. Mike's going to show you that chart and talk to a little bit about how FOMO can cost you a lot of dollars. And then, of course, we're going to wrap up with some keeping things in perspective like we always do. But before we get started, this financial education presentation, you have to do your own due diligence for acting upon anything you hear today. More disclaimer information is available at ankerstarwealth.com, and the opinions expressed are Mike and mine alone. Let's go over to CNBC, take a look at the latest. They're on break, so we'll scroll down to this headline on CNBC.com, take off overnight Israel strike on Iran. So, spent my whole military career in the Middle East, so kind of familiar with this particular scenario, and it's an ugly one. So what happened? So you had the Israel strikes against Iran back in the day inside of Syria, if I have that right, and some Iranians were affected on their facilities. So Iran took action this weekend to send 300 plus missiles into Israel. No fatalities. I heard there might have been one, but they've said officially no fatalities. It was unrelated. And now you have the response. So out of this response, it could have been from anything from that's okay, we'll consider this a truce and not do anything, all the way to, both sides have nukes here, so you don't want that to happen, or anything in between. So obviously, I would have to imagine the U.S. government was heavily involved in making sure that the response was tailored, appropriate, all those other things we used to talk about all the time. So it appears that we got that. So in my mind, this is like the best case scenario is, they struck back. I haven't heard the death toll or exactly the damage toll, but it may have been symbolic in nature. And hopefully this will be the end of what they call the tit for tat, right? Or it's not. It's just simply then we're going to see another strike from Iran, this weekend or whatever. That's what we don't know. That's why the market, whenever you have this massive uncertainty out there, that's why you have the market selling off. And Mike will cover that here in a minute. But what I think is overall, I interpret this as a good sign. I'm not rushing the portfolios off to safety over this specific event due to all the things we've talked about. Obviously, that would change if we start, if the reattack this weekend is of super significance, I shall say. But that's all I'm going to talk about on the issue, but kind of thrilled. You're never thrilled with a kinetic attack on another country, but as far as an appropriate level of response, I think they kind of nailed it as far as this seems about right. All right, over to you, Mike, to talk to us about the S&P 500 and what red looks like, I guess. Other than the red I have on my jersey, it matches the market, right? So,
yes, the last few days we've had several starts where we saw green in the morning and red in the afternoon, ultimately to finish in the red. But today we're just starting in the red, based on last night's strikes. And really, it's not down much, only down 0.3%. The S&P is down, but this is the 6th day in a row. So that is, sad. We don't like to see that. We want to see green. We want to see everybody's portfolios go up. But then again, you get to buy things on sale, which we always like buying things on sale. So S&P down, let's just acknowledge it. I mean, this is the business we're in. Let's acknowledge it's down. We don't control this. We just appropriately invest dollars so they can take advantage of the snapback rebounds, things like that. But when it comes to overall markets, one of the things that is a great topic is FOMO, fear of missing out. We hear that term all the time. And I found a nice chart, compliments of Meridian Financial Partners, that kind of show how this works. And as things go up and you start on the left, optimism, excitement, thrill, euphoria, like these stocks are going to, a million. The market's hot. I've got to buy. I got to buy at the top. Or we don't say the top, it's going to keep on going. That's the belief. And in fact, when I was taking some master's classes in the 90s, I remember a financial officer coming in and saying, hey, do we really believe that Yahoo, the stock Yahoo, is worth more than General Motors, Ford, and Chrysler all put together? Like, this is a email access program back then. Is it worth more than all the automotive production in the United States? And the financial guy was like, absolutely not. But we believe in what's called the bigger fish theory. We buy here because we think there's a bigger fish that's going to buy it higher and higher and higher. And I always remember that because I worked for the automotive companies then. So that's what happens in euphoria. It goes up until somebody is left holding the bag at the top. Then it goes down and we get the temporary setback. I'm a long-term investor. I'm sticking with this stock. And it gets more and more and more painful to finally, it's like, oh, I've lost 50% of my money. I got to sell. This never end. It's going to zero. I'm out. And this is the process of FOMO. And it's, as I think about it, it's very natural. It feels like I want to be in when things are up at the top and I want to be out when things are bad. It's just natural to feel that way. But that's part of our job to make sure overall our investments do not go this way. So let me bring up Supermicro, because this is a great example of, and I did not get a lot of calls on this in January, February, but I remember seeing this thing go up. It's an AI play, and you can see it started 2024 at $250 a share, and it peaked at $1,225. So it basically 5-timed your money if you put it in January 1st. And like, oh, wow, I want a piece of that. The question is always, when would you sell? Would you have been that person that sold right at $1,229? Probably not. You might have been like happy, hey, I just went up 30%, I'll sell. Or you may be in that cycle right now where you're holding on. And I'm not saying this stock is like the overall market, because this is one stock. It could be going to zero. I have no idea. But you're seeing a stock that went up to 1,200 and it's dropped 40% since then. So this is a wild ride. So if you were thinking, oh, I should have got in on it, it'd be hard to pull the trigger now. But if you wanted to buy it on sale, you could. It's down 17% today and 40% overall. So how do we prevent that? What are some things to understand? And I want to bring up another term that I had not heard before today. JOMO. Steve, you know what JOMO stands for?
Nope, I'm excited though. I like learning. What's JOMO?
It's the joy of missing out, right? The joy of missing out. So let me bring up a slide, and this is the joy of missing out, but there's a downside to it. So how many times has the market dropped 5% or more in a day? Or these are the 15 largest times the market dropped 5% in one day. Now, you'd have JOMO if you missed this day. If you were like, I was sitting in cash and the market dropped 20% in one day, believe me, you'd be jumping around with JOMO. Like, I can't believe I missed out on that. But here's the catch. Could you get back in? The market goes down 10% or 5%. Could you say, okay, now I'm back in? Because usually it's very, very bad news that causes this. And if you look, many of you have experienced in 2020, there's a few bad days in here, down 12% on March 13th, down 10%, 9.5% on March 11th. And you'd be like, if you sat out those days, could you actually put your money in? Probably not. It's pretty aggressive. But what I want to focus on today is what happened the next year. So The market does have these days where it goes down a lot. It didn't happen from this attack last night, but it could happen next week. It could happen next year. We don't know. These are events that usually cause this. But look what happens a year later. Every of these top 15 drops, 1 year later, 14 out of 15, the market was up significantly higher. Only one, and it was early in 2008, it stayed down over a year later. But so take a day like October 16th, 1987, the market drops 20%, painful. But a year later, it's up 23%. So you're at least up. But take the next one, down 12% in one day. A year later, it's up 66%. So I'm just showing this slide now to say this will happen. The market, there will be times when the market will drop. It could be based on a geopolitical event. But generally 14 out of 15, obviously we never know the next one. A year later, it's back. This shows 3, 5, 10 years later, you're fine. So just be prepared. This can happen. And I just want to say thanks to First Trust for supplying this kind of a slide. Very helpful to show this. So.
Yeah, that's great information, Mike. So much to unpack here. You know, we got the JOMO, the new term, and I will say that you know, this is why the emotions of investing can get the better of anybody. So that's why you need to have processes in place, use quantitative tools to kind of help you with that. So that's why, you know, it's one thing if it's in your $1,000 fund money account. It's not as funny as if you're in your $500,000 401k and you're doing this stuff. So, you know, that's why it's better to turn it over to a professional team and let us look at this. So how do we execute on this? Well, we're around this a lot. So the emotions, again, are a lot lower level because we're used to seeing this stuff. And we have these tools at our disposal to kind of help us keep that in perspective. In addition, when I talk about a quantitative methodology to help assist with this, it's the use of models. So when you think, when you hear us talk about the models and you're like, okay, model, schmodel, whatever, model, blah, 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 right? No, not blah, 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 because it helps with this, you know, buy low, sell high mentality. And the selling's the hard part. Most of us are pretty good. Hey, when the market sells off and I can buy Apple today at 162 when I would have paid 195 for it a month ago, whatever, I like it, right? If the long-term thesis is intact, then I buy. What's really hard to do is that selling at the top. From what Mike talked about in recency bias yesterday is, you know, if it's up huge, it's going to just continue to go to the moon, right? That's where the models can step in. And, you know, we look at the account and we hit, you know, rebalance and it'll say, hey, trim some of this service now, trim some of this. If you were in Super Mike's right there, but Super Micro computer, if you're in that, it's going to say, hey, you're supposed to trim here. So at least it gives you that, hey, dummy. Remember, we're supposed to trim some at the top, and that's what helps us with it to again make those decisions. So a lot of good stuff this week, a lot of things to think about. When I was joking with Mike yesterday, saying sometimes when people, you know, you meet people all the time, they're like, "What do you do?" If you say financial advisor, they try to, you know, get out of the conversation, right? Because you're going to sell them some insurance and their annuity, or tell them to buy gold or something. But if you tell them you're a therapist, is how I answer the question sometimes. They're like, "Really? What kind of therapy?" And I'm like, financial. And they're like, "Oh, you help people stop spending." And I'm like, well, that's a part of it. But no, a lot of this stuff can just get the better of you, and it'll help you with your relationship with money. So all in all, great information. What I would like to see is on Monday, a nice big green day, so we can stop talking about all this psychological stuff and talk about, hey, what we bought and what we're buying as the market continues back up. With that, we're going to let you guys have a good weekend, and we'll see you back on Monday. Have a good one. Bye.